Welcome to the Deep Dive. We're about to explore a financial report that, honestly, at first glance, seemed to almost contradict itself.
It really does.
Imagine this. A company sees its revenues go down, its net loss actually gets bigger, but somehow its gross profit has just soared by a huge amount.
Yeah, how does that work? It sounds completely backwards.
Exactly. So today, we're going to peel back the layers on this fascinating financial puzzle. It really reveals a company right in the middle of a pretty dramatic strategic shift.
It's a really compelling snapshot, isn't it? A business basically trying to reinvent itself on the fly. We're talking about Linkage Global Inc., sometimes known as Linkage Cayman.
Right.
They're a cross-border e-commerce integrated services provider, headquartered in Japan, but they operate across Japan, Hong Kong, and mainland China, too. And historically, they've kind of had two main things they do.
Two main business lines.
Yeah, traditional cross-border sales, buying and selling goods across borders, and then these integrated e-commerce services.
Okay, so our mission today is to really unpack Linkage Global's latest numbers. These are unaudited results for the 6 months ending March 31st, 2025.
Yeah.
We'll compare them to the same time in 2024.
And figure out what these surprising shifts really mean. What's the strategy behind the numbers?
Precisely. So let's jump right in. Okay, let's start with those big headline figures that kind of make you scratch your head. First up, total revenues. They actually decreased.
Yeah, dropped by about $1.3 million, landing around $3.5 million.
Which is a 27% decline compared to the $4.8 million they did in the same period in 2024. So not exactly a great start on the surface.
Not at all, but then almost, paradoxically, the gross profit just went through the roof.
It really did. It increased massively by about $1.99 million, hitting $2.7 million.
Which, get this, is a 280.57% increase compared to the $0.71 million in 2024. Just incredible growth there.
This is where it gets really weird, though. Because while that gross profit soared, their bottom line, the net loss, also got worse.
Right. It increased by about $1.68 million, ending up at roughly $3.09 million in the red.
That's a 119.62% increase in their loss from the $1.41 million loss in 2024. So, looking at it cold, it's just confusing. Revenue down, gross profit way up, net loss also way up.
It seems like a mess.
Yeah. So how do you even begin to untangle that? What's the first place you look?
Well, that paradox is really the key. And to understand it, you absolutely have to break down their revenue streams. Because what you find is, like we hinted, almost two different businesses under one corporate roof.
Okay.
And one is shrinking very fast, while the other one is, surging. The first part of the story is that sharp decline in their traditional cross-border sales business.
And sharp is the word. Revenues from cross-border sales just plummeted, down by roughly $3.74 million.
An 82% drop.
Yeah, 82.35%. From about $4.54 million down to only $0.80 million. And just to give a specific example, their Japanese subsidiary, Extend, it only brought in $0.43 million. That's just 12% of total revenue. And it's down a massive 87.66% compared to the previous year.
Wow.
And the report is pretty clear why it says it was mainly a poor market response to their strategy focusing on 3C electronics. Computers, consumer electronics, that kind of stuff.
Right. That market can be really tough, very competitive, often low margin. But what's really crucial here, I think, is how the company reacted. They weren't passive.
They moved fast.
Very fast and pretty decisively. They shifted focus, reallocated people towards those higher margin, fully managed e-commerce services we mentioned.
Okay.
And they're not giving up entirely on cross-border, but they're restructuring it, looking at new types of products and even planning to explore things like TikTok shops and live stream selling in Japan. It shows a very deliberate strategic pivot away from what wasn't working.
That makes sense. Cut your losses,
Yeah.
or at least shrink the part that's bleeding and double down elsewhere.
Exactly. Which leads us right to the other side of the story, the incredible surge in their integrated e-commerce services.
And surge is almost an understatement here. This revenue stream didn't just grow, it absolutely exploded. Revenues shot up by, $2.44 million?
Yeah, which is a 930% increase, 930%. From just $0.26 million to $2.70 million.
That's phenomenal growth. What exactly is driving that?
It's largely down to launching this new service line in 2025, the fully managed e-commerce operations. Think of it as an end-to-end solution for merchants.
So they run the whole online store for them?
Pretty much, start to finish.
Yeah.
And their fees are based on the gross merchandise volume, the GMV.
Ah, okay, so the total value of stuff sold.
Right, and this new model, just on its own, brought in $2.59 million in revenue and, importantly, $2.46 million in gross profit.
Wow. So almost all of that revenue is flowing straight to gross profit.
Almost entirely. We'll get to why the margins are so high there in a bit.
Okay. And they did mention a couple of other smaller revenue stream changes too, right?
Yeah, minor notes, really. Digital marketing revenues dropped a bit because they ended a partnership with Google. And their training and TikTok agent services were down significantly, about 75%.
But those are small compared to the main event.
Definitely. The big story, the real strategic shift, is pulling resources from that declining cross-border business and pouring them into this booming integrated e-commerce model.
Got it. So let's shift then. Let's talk costs and margins, because this is where we should really see how that gross profit managed to soar even while overall revenue fell.
Exactly. And the first piece is the cost of revenues. It fell dramatically.
By how much?
By over 80%, 80.34%, down to just $0.80 million.
And that's mainly because?
Mainly because the costs tied to those cross-border sales vanished along with the sales themselves. That cost line dropped by $3.33 million, which makes sense. They simply weren't buying as many electronics to resell.
Good, that tracks. Less sales, less cost of goods sold.
But interestingly, and this is a key detail, the costs for the integrated e-commerce services actually went up slightly.
Oh.
By how much?
Just a small amount, about $0.04 million, bringing the total to $0.17 million. But most of that increase, $0.13 million, was directly tied to that new fully managed e-commerce business.
And what were those costs?
Primarily staff salaries. People moved over or hired to run these new services. So it really highlights that internal shift, moving resources from one area to another.
Right. So the costs follow the strategy. And this combination, managing costs down in the declining part, shifting resources, and the revenue shift, that's the engine behind the gross profit jump.
Absolutely. That's the heart of it. Remember, gross profit shot up by nearly $2 million to $2.7 million. And the undeniable driver was that new, fully managed e-commerce business,
which contributed almost all of that profit.
It contributed $2.46 million in profit, with an astonishing gross margin of 95.12%.
95%? That's almost unheard of. Well, the report gives a couple of reasons. First, very low operating costs for this service line, mainly just those staff salaries we mentioned. Second, and this is important, there were no enterprise resource planning ERP system development expenses hitting the books in this period.
Ah, so those big IT development costs were likely recognized earlier.
Exactly. They'd already incurred and accounted for them probably in a previous period. So this new service line started lean, at least in terms of recognized costs for this reporting period.
That makes a huge difference.
It does. And what's also fascinating is they improved margins elsewhere too, even in the shrinking business. Cross-border sales margin actually improved from about 12.7% to 21.3%.
How did they manage that if sales were collapsing?
By shifting the type of products they did sell within that segment towards higher margin items, getting rid of the worst offenders, basically.
Yeah.
And the overall integrated e-commerce services margin also jumped from around 50% up to over 93%, again, thanks mainly to that new, super profitable, fully managed model. It shows a real focus on profitability, not just revenue.
Okay, so the picture is becoming clear. Strategic shift to high-margin services, ruthless cost control in the declining segment, resulting in great gross profit. But that still leaves the elephant in the room, the growing net loss.
Right. The bottom line still went the wrong way.
So let's follow the money down the income statement. Despite these efficiencies at the gross profit level, overall operating expenses actually rose quite a bit.
They did, up by 91% to $4.34 million.
And what was the main culprit there?
The big one was general and administrative expenses G&A. That ballooned by almost 124%, hitting $3.90 million.
Wow. And what's in G&A that drove such a huge increase?
The report points to a few key things. One is an allowance for credit loss. That's money set aside because they don't expect to collect on some debts owed to them.
Okay. Standard accounting practice, but can fluctuate.
Right. Another big one was stock-based compensation, giving shares to employees instead of cash. That's a non-cash expense, but it still hits the income statement.
Common for tech-related companies, especially post-IPO.
Exactly. And the third major driver was post-IPO financial and legal consulting fees. These are often significant, sometimes one-off costs that hit right after a company goes public. Think auditors, lawyers, compliance advisors.
So a lot of costs not directly tied to selling products or services day to day, but more corporate overhead and maybe some one-time post-IPO stuff.
Precisely. Though stock comp can be recurring, now there were some offsets. Selling and marketing costs actually dropped by about 31%.
Why was that?
Lower freight costs, likely tied to the drop in physical product sales and less advertising spend.
Makes sense. And R&D.
Research and development expenses also declined slightly by about 8%. The report says this was because some ERP development staff were shifted into operational roles.
So their salaries basically moved from R&D expense to cost of revenues or maybe G&A, reflecting their new duties.
Exactly. So some cost management in those areas, but they were completely swamped by that surge in G&A.
Okay, G&A up. But that still doesn't feel like the whole story for the net loss increase. Was there anything else significant?
Oh, yes. This is where it gets really, really interesting. And frankly, a bit alarming. Net interest expenses.
Ah, the cost of debt.
It didn't just increase, it exploded from only about $60,000 in the 2024 period to approximately $1.5 million in 2025.
$1.5 million in interest expense, up from almost nothing. What happened?
They took on significant debt. Specifically, they issued $10 million in convertible bonds back in October 2024.
Okay, convertible bonds, common enough. But the interest must be high.
High doesn't even begin to cover it. The report states the actual interest rate on these bonds is 42.52%.
42.5%. Are you serious?
Dead serious. 42.52%. That is an incredibly high interest rate. It signals either extreme desperation for cash or that lenders saw this as a very, very risky bet.
I mean, that's astronomical. That explains the massive jump in interest expense.
It certainly does. That bond issuance alone generated $1.56 million in interest expense during this 6-month reporting period. Think about that. Just the interest costs wiped out more than half of their gross profit?
So roughly half of their entire net loss for the period is just the cost of servicing this one batch of debt.
Pretty much. It's not just a headwind. It's like sailing into a financial hurricane. It really underscores the high-stakes nature of the strategic pivot they're attempting. They needed the capital badly to fund this shift.
Wow, okay. That 42% figure is just stunning. Anything else impacting the bottom line? Taxes.
Yes, a smaller impact, but still notable. They went from getting a small tax benefit last year, about $20,000, to having a tax expense this year of $0.34 million.
And why the swing?
Primarily because that new, fully managed e-commerce operation was actually profitable on its own, and profit attracts tax. The report mentions a 16.5% tax rate applied to that segment's net profit.
Okay, so the profitable part started paying taxes, which contributes to the overall net loss when combined with losses elsewhere and those huge interest costs.
Exactly. So you put it all together. The strategic shrinking of cross-border sales, the massive growth in high-margin e-commerce, the ballooning G&A costs, and critically, that enormous interest expense bomb.
And the result is the net loss widening by $1.68 million to end up at $3.09 million.
That's the story the numbers tell.
So stepping back, what does this all mean for you, the listener, trying to understand this company? This deep dive really paints a picture of a company in a very deliberate, maybe even forced transition.
It's fascinating, isn't it?
It really is. It's almost a textbook case study in business adaptation. They're making a huge strategic bet, essentially cutting off a limb, that lower-performing 3C electronics business, to aggressively grow a new, much higher margin one in fully managed e-commerce.
A very focused gamble.
Yeah. And those financial paradoxes we started with, revenue down, gross profit up, net loss up, they aren't contradictions. They're actually the symptoms of that strategic pivot. They reveal a company taking on significant short-term pain, like those sky-high interest rates and big G&A costs, all in the hope that this new, more profitable business model will eventually win out.
It's dynamic, it's risky, and it's happening right now.
Absolutely. So just to recap the narrative we've uncovered, we've seen Linkage Global strategically pull back from its traditional cross-border sales,
shifting people and focus squarely onto that booming, high-margin, integrated e-commerce services model, especially the new fully managed part.
Right. And while that shift led to that really remarkable profit growth,
it also came bundled with significant new costs, particularly those hefty G&A expenses, and, crucially, the enormous interest payments on that new financing.
Which, all combined, resulted in a larger net loss for this period.
A classic investing for the future story, perhaps, but with unusually high financing costs attached.
And Linkage Global itself included a reminder in their report, the standard safe harbor statement, basically saying, look, these are forward-looking statements, things involve risks, actual results could be very different.
Always important to remember.
Definitely. So considering this really aggressive pivot they're making, focusing so hard on the high-margin services, but saddled with that incredibly high 42.5% interest rate on the convertible bonds.
Yeah.
What do you think? What are the most crucial numbers or trends you'd be watching for in their next financial report? What tells us if this transformation is actually working, if it's sustainable, and crucially, if that new business can grow fast enough to outrun those huge financing costs?